The US is shut today for Thanksgiving, and it will be for the next few days. So rather than dwell on anything, because there's nothing really important that's going on when the US is shut or anything that you need to act on, I'm just going to mention some of the news that has come out today from Ofgem, the UK's energy regulator. Now, bearing in mind the context here, Ofgem is the regulator and they have a mechanism whereby they can apply a price cap on each unit price of UK energy, which is there to basically, in their eyes anyway, to limit any crazy price spirals. But in fact, it was found at the Bank of England, that this price cap actually led to inflation being more elevated. Now, what they've come out with just over the last 24 hours is that the price cap is going to increase by 5% on the previous quarter from 1st of Jan to the 31st of March 2024. For an average household paying by direct debit for dual fuel, this equates to £1,928, a rise of £94 over the course of the year, around £7.83 a month. Now, this isn't a huge increase at all, especially by, 2022 standards. But the thing that I'm struggling to understand is why it's happened at all. And I'll show you why I'm saying this. Now, if I get a price chart of Nat Gas Henry Hub futures up here, let's take a look. You can see here that Henry Hub futures, which are a US futures contract, have traded actually to effectively a new low, if you like. Now, UK baseload power is up, so UK nat gas prices are indeed up. But the fact of the matter is that this doesn't marry up with what Ofgem is saying. So they're saying that today's price increase is driven almost entirely by rising costs in the international wholesale energy market, due to market instability and global events, particularly the conflict in Ukraine. But the market's not showing that. They're using a 2022 opinion or view to basically enact a policy now. And the policy doesn't make sense. And you can see this from the actual charts. I don't really understand what's going on. And considering the Bank of England had said, energy prices were a contributing factor, or a massively contributing factor to UK inflation, especially the price cap, actually. They mentioned that specifically back in April or May, I believe it was, just before the price cap started to get reduced again. Considering this, I feel like it is quite a bold and a move that needs to be investigated, because it doesn't make sense to me. The only thing that I can see is that about 6 months ago, maybe, producers started to hedge their prices a little bit higher, which means that, the price had smoothed out or flattened out a tiny bit higher than what it should have been. But still, this doesn't make sense either. So I'm really struggling here, and I'm really trying to question why this has happened, and what the outcome should be. I would expect there to be quite a lot of noise about this over the next couple of days, because it doesn't make sense from anyone who has an idea about the market as to why this has happened. Now, the only way you can get the best trading insights, education, and analysis each day is if you're here every day. So hit subscribe so you can get your daily trading edge. Market shut today, so it gives us a great opportunity to talk about something very important, which is liquidity. Now, what is liquidity? Well, it is effectively the ease at which you can enter and exit a market without disturbing the price. So FX, for example, is an extremely liquid asset class. You can get into euro dollar on the bid and offer at a spread of sometimes 0.1, for example. Now, liquidity is extremely important because over time, your trading costs will accumulate. Now, a lot of study on bank, hedge fund desks, etc., broking desks are done on the extent to which you can enter and exit a market. Because if you can imagine, if you are throwing about massive position sizes, over time, the amount of costs that you pay might even eat into your strategy, so the returns that you might make. A day like today, when it's US Thanksgiving, it's probably quite prudent not to trade, purely because the spread will be moving all over the place. If you were to market order into the market, you might see a spread of maybe 5 to 10 times more than usual hours, for example. So liquidity is absolutely vital when you're looking at deploying your strategy in the most sensible and optimal way. Trading costs are a massive, massive facet of any strategy, and it's very, very vital to pay attention to it. You can mitigate lots of problems with liquidity by using limit orders, where you are always going to get filled at the price you want. But generally, it's advisable not even to trade on things like US holidays, because the US dominates the market. And if there's less volume going through from the US, there's less direction, less motivation, and overall, you're just putting yourself at risk.